By April 2026, Nvidia has transcended its role as a hardware provider to become the primary infrastructure of the digital age. Its market capitalization now rivals the entire annual output of the German economy, creating a valuation puzzle for every global investor. The core question is whether the current price reflects future earnings or speculative fervor. Trading at 30 times forward earnings, the market assumes that high double-digit growth in data center revenue will remain constant for the next 5 years. With the Blackwell architecture fully deployed and the Rubin platform entering mass production, Nvidia has compressed its development cycle to just 12 months. This rapid iteration prevents competitors from achieving performance parity before the next generation arrives. Data center revenue now accounts for nearly 90% of total earnings. This concentration creates a singular dependency on cloud service providers, who are simultaneously Nvidia's largest customers and its most significant long-term competitive threat. Gross margins have stabilized at a remarkable 75%. Maintaining this level of profitability requires a near monopoly on high-end compute, as any price war would immediately erode the premium valuation multiples investors currently pay. The top 4 cloud providers have allocated over $200 billion in annual capital expenditures. A significant portion of this goes directly to Nvidia chips, yet the risk of a spending plateau looms if artificial intelligence monetization fails to scale. Internal chip development at Amazon, Google, and Microsoft is accelerating. These application-specific integrated circuits are optimized for specific internal workloads, potentially reducing the total addressable market for Nvidia's general-purpose graphics processing units. The real moat is not the hardware, but the CUDA software platform. With millions of developers deeply integrated into this ecosystem, switching to alternative hardware requires a total rewrite of existing codebases, creating massive friction for migration. As models move from training to inference, the compute requirements change. While training favors Nvidia's massive bandwidth, inference can often be handled by cheaper, more power-efficient chips, representing a pivot in the valuation narrative. Nation-states are now building their own sovereign artificial intelligence clouds to ensure data security and technological independence. This creates a new tier of demand that is less sensitive to corporate profit cycles and more focused on national strategy. Nvidia remains reliant on Taiwan's semiconductor manufacturing company for chip fabrication and advanced packaging. Any disruption in the Taiwan Strait or a bottleneck in CoWoS packaging capacity directly limits Nvidia's maximum quarterly revenue potential. Nvidia generates more revenue per employee than almost any other company in history. This extreme efficiency supports a high valuation, but it also means that top talent retention is critical, as the loss of key architects could derail future roadmaps. Nvidia is no longer just a chip company. It is a networking company. Their InfiniBand and Spectrum-X systems represent a massive portion of revenue, ensuring that the entire data center fabric is locked into the Nvidia architecture. In a discounted cash flow model, over 60% of Nvidia's value resides in its terminal value. Small changes in long-term growth assumptions or the discount rate can lead to massive swings in the calculated fair value of the stock. When adjusted for growth, the price-to-earnings-to-growth ratio appears more reasonable than the headline multiples suggest. If earnings continue to grow at 40% annually, the stock may not be as overvalued as bears claim. Analysts track the ratio of inventory to purchase commitments. A rising backlog indicates strong future demand, but any sudden cancellation of orders from major cloud providers would lead to an immediate and painful inventory write-down. The physical limit to Nvidia's growth might be the power grid. Data centers are reaching the capacity of local electrical infrastructure, potentially slowing the deployment of new clusters, regardless of chip availability or corporate budget. Beyond the data center, Nvidia is positioning for the robotics and industrial digital twin market via Omniverse. While currently a small fraction of revenue, this segment is the primary bet for growth in the late 2020s. As a long-duration growth asset, Nvidia's price is highly sensitive to interest rates. A higher-for-longer rate environment increases the discount rate applied to future cash flows, putting downward pressure on the equity risk premium.
Advanced Micro Devices has emerged as a credible second source with their Instinct series. While they lack the software ecosystem of CUDA, their competitive pricing and open source strategy appeal to customers seeking to avoid total vendor lock-in.
Institutional ownership is at record highs, meaning the stock is a staple in almost every index and mutual fund. This provides stability, but also creates a risk of a cascading sell-off if a major macro catalyst triggers a rotation out of tech. With massive free cash flow, Nvidia has aggressively increased share buybacks. By reducing the share count, the company can grow earnings per share even if net income growth begins to moderate from its current triple-digit levels. The next phase of the valuation story involves edge computing. If smartphones and personal computers require specialized Nvidia hardware for local model execution, the addressable market expands from thousands of data centers to billions of consumer devices. The gaming segment, once the company core, is now a secondary factor. It provides a steady cash flow floor and continues to drive graphics innovation, but it no longer dictates the stock's overall trajectory or valuation multiple. Geopolitical risk remains the most significant unpriced tail risk. Because Nvidia depends on a single island for its most advanced silicon, any escalation in regional tensions could halt production entirely, a scenario no valuation model can fully mitigate. Nvidia is shifting toward a software-as-a-service model with Nvidia AI Enterprise. Transitioning from one-time hardware sales to recurring subscription revenue would justify a significantly higher valuation multiple, typical of the software industry. The quality of earnings is high, with nearly 100% of net income converting to free cash flow. This allows Nvidia to self-fund its massive research and development budget without relying on external debt or equity dilution. Nvidia's research and development spending is highly focused. By concentrating on a unified architecture across all segments, they achieve a return on investment that far exceeds more diversified semiconductor companies like Intel or Samsung. With over 90% of analysts maintaining a buy rating, sentiment is overwhelmingly positive. This creates a high bar for quarterly results, where even a slight beat and raise might be perceived as a disappointment by the market. Retail investors and short-term options activity often drive extreme price volatility. Gamma squeezes can push the stock far above its fundamental value, leading to sharp corrections when the technical momentum shifts or the delta hedging unwinds. The semiconductor industry has historically been deeply cyclical. Bulls argue that artificial intelligence has created a structural shift or supercycle that breaks this pattern, while bears warn that a massive build-out always leads to an eventual glut. As electricity costs become the primary operational expense for data centers, Nvidia's lead in performance per watt is a critical competitive advantage. Total cost of ownership, not just the chip price, is what keeps hyperscalers buying Blackwell and Rubin. Nvidia's pricing power is currently absolute. They can command prices for individual H200 or Blackwell units that are 10 times their manufacturing cost, because the productivity gains for the customer justify the extreme capital outlay. The net worth of many Nvidia engineers has exploded due to stock grants. This creates a unique retention challenge, as many key employees are now financially independent and may choose to retire or start their own competing ventures. Nvidia carries virtually no net debt. Their massive cash pile provides a strategic buffer and the ability to acquire emerging startups in the software or silicon space, further solidifying their grip on the entire artificial intelligence stack. Regulatory scrutiny has blocked large acquisitions like ARM in the past. Consequently, Nvidia now focuses on smaller, tactical acquisitions that bring in specific intellectual property or specialized software teams without triggering antitrust red flags. In the bull case, Nvidia becomes the operating system for the entire physical world. Automated factories, autonomous vehicles, and personalized medicine all run on Nvidia silicon, justifying a valuation of $10 trillion by the end of the decade. The bear case centers on a return to cyclicality. If hyperscalers finish their initial clusters and shift to internal chips, Nvidia could face a massive revenue drop, similar to the post-crypto mining crashes of previous years.
A reverse discounted cash flow analysis shows the market expects 25% compound annual growth for the next decade. To beat the market, Nvidia must outperform this already aggressive expectation, leaving a very thin margin of safety. For conservative investors, the margin of safety is slim. Buying at these levels requires high conviction that the artificial intelligence revolution is in its earliest stages, and that Nvidia's technological lead is insurmountable by any rival.
Investors must also consider the opportunity cost. While Nvidia is a dominant force, the excessive concentration of capital into a single stock creates significant portfolio risk compared to diversified index funds or other emerging technology sectors. Comparisons to Cisco in the year 2000 are frequent. Cisco provided the plumbing of the internet, but once the build-out was complete, the stock collapsed despite the internet's continued growth. Nvidia's software moat is the key differentiator here. Is it priced in? The current valuation accounts for a continued monopoly and flawless execution. Any deviation from this path, whether through competition or macro headwinds, will lead to a significant repricing of the stock's future potential. For those holding Nvidia, rebalancing is a key tool to manage risk. For those looking to enter, dollar cost averaging during periods of high volatility may provide a better entry point than chasing momentum during peak sentiment. The math behind Nvidia is a bet on the future of intelligence. Whether the chips are priced in depends entirely on whether the world is entering a decade of hyper-productivity or a period of overextended capital investment.